Hello and welcome back to your South King County Real Estate Update, a very special episode of South King County Real Estate Update, your housing market update 2024 recap 2025 predictions episode. So I love doing this episode every year. I think it's fun to go back and watch my past ones and see how close I was. But I go back and look through a whole bunch of experts' predictions and compile them for different areas and go back through the past year, look at where we've been. So I will go ahead and jump right on into these slides. So 2024 recap, 2025 predictions. Can you believe it's the end of the year already? And make sure to stay tuned till the end of this for some announcements on some upcoming classes. Into the 2024 recap. For home price activity for King County, we're just barely above where we were last year. For condo sales, this is the number of sales. We were up in all areas from a year prior. Condo sales also up, except for Southwest and Southeast King County, down slightly, but overall prices have come up ever so slightly from a year before. And these are November numbers because December has not ended yet. And I am one of the first people to do the predictions episode. So I don't have the December numbers yet because December is not yet complete. New listings in all areas. We are down from a month prior, but up in Auburn and Federal Way from where we were a year ago, about right here. Down in Kent and Renton from a year ago, up in all areas in the number of pending sales from 1 year ago. I'm breezing through this because I covered this in the December update, but just to give you a little snapshot of where we are at. Kent up 100 days for the median days on market. So it was 13 last year, and this year it's 26. Renton is actually down from a year ago by 5%, and Auburn and Federal Way are both up pretty significantly for the number of days on market. So this just means that homes are on average sitting on the market a little bit longer than they were a year ago. And median sales price is up in all areas, although Kent is pretty flat from a year ago. Auburn up 25% for median sales price from a year ago. But Federal Way at 6%, that's pretty normal appreciation, would be 6%. 25 and 12.8%, that is abnormal appreciation. But these are smaller sample sizes, so it doesn't quite tell the whole tale. For mortgage rates, just to give you a snapshot of where we are at, the average mortgage rate on 30-year mortgage climbs to 6.85%, the highest since July, as bond yields keep rising. The average rate on a 30-year mortgage did rise for the second week in a row. We have had a pretty sharp increase. The rate rose to 6.85 for our weekly average. And the Fed did meet recently, and basically everyone was expecting them to do exactly what they did, which was a quarter point drop in the Fed funds rate, which affects the bond, which then affects mortgage rates. So it's a whole chain reaction process. Most economists, based on what's happening right now, are forecasting that 30-year mortgage will remain above 6% for the next year, with some including upper ranges as high as 6.8 as the average for next year. So jumping into this, the bond yields climbed last week after the Federal Reserve signaled that it will likely deliver fewer cuts to rates next year than it forecast just a few months ago. So they have reeled it in with what they are planning to do next year based on the current information. There was some unfavorable inflation data that came back, and there's some predictions of what will happen with Trump's policy initiatives. What he's projecting to do will contribute to higher inflation and swell the national debt, which could keep mortgage rates elevated. But that's because what happens with inflation, the US deficit and the economy can have an effect on the 10-year Treasury yields. So that's what I was explaining before. But Trump's policy, we'll get into that in another slide, but there's two ways that could affect mortgage rates in the future, and they're kind of contradictory. So we'll see what happens there. But into today's interest rate, that is 7.11. This is an article that came out earlier today. Mortgage rates, little change today, this year, and over the past 2 years. In September 2022, 30-year fixed mortgage rates crested 7% for the first time in more than 2 decades. The following year saw rates move momentarily under 6% and over 8% before returning to 7% by December. Surely that broadly sideways performance in 2023 meant that a corner had been turned. Up until the past few months, 2024 indeed looked like it had a decisively more hopeful year. To be fair, it was still better than 2023, but ultimately it was just as sideways in the end. So we got here a couple different ways, but basically 2023 and 2024 rates ended kind of flat from where they started the year. So 2023, January to December, it's 6.5 to 7, even though we kind of roller coastered around here. 2024, less of an intense roller coaster, but we still did this big dip down and things looked really hopeful. And then we bounced back up to the 7% range. Basically starting and ending the year almost flat as far as rates are concerned. Looking forward, is this going to be where we are at 2025? Are we going to fluctuate and end 2025 right around 7%? That, of course, is to be determined, but really inflation is not right where the Fed wants it to be. And until we get that solidly right around that 2% goal rate, mortgage rates will be a little bit higher because this is how they can affect the economy and stop the inflation from going higher. I thought this was interesting. If there was a saving grace, it's that the 3-year time frame, 2022 to 24, now looks a lot like the 1980 to 1982 in terms of the trajectory of rates. And that was the big turning point for the only comparable episode in modern economic history. So I included 1980 to 1986 down here. So we had the big up and then down, and then in 81, it went way up and then came down, and we had this kind of jaggedy downfall. And we kind of did the same thing here in the last couple of years, up and then down and then big up and then kind of jaggedy down from there. So these two charts are pretty similar. So if it follows this history, rates will go down heading forward, but who knows? This is the only comparable episode in modern economic history where this type of thing has happened. And rates for the past year, as I said, they started a little bit under 7, ending right around 7 for the past year. For inflation, the Federal Reserve's preferred inflation gauge shows price pressures eased last month. Inflation gauge that is closely watched by the Federal Reserve barely rose last month in a sign that price pressures cooled after 2 months of sharp gains. So we had on Friday's report, prices rose just 0.1% from October to November. Excluding the volatile food and energy categories, prices also ticked up just 0.1% after 2 months of outsized 0.3% gains. So in this measure of inflation, things are cooling. The milder inflation figures arrived 2 days after Federal Reserve officials, led by Chair Jerome Powell, rocked financial markets by revealing that they are now expected to cut their key interest rate just 2 times in 2025, down from 4 in their previous estimate. So I was talking about how they had decreased that estimate for cuts next year. This is that. Stickier inflation, Powell said, might be the single biggest factor causing the central bank to reduce the number of rate cuts it envisions. Fewer Fed rate cuts would likely mean that mortgage rates and other consumer borrowing costs would remain elevated. So year-over-year inflation edged to 2.4% in November from 2.3% in October, and that is still above the 2% target by the Fed. But spending remains strong. Incomes also rose 0.3% last month, faster than prices, which is a trend which, if continues over time, should help Americans adjust to the higher costs. So these inflationary numbers, we're here to stay. Prices aren't going to drastically decrease. We need to get to the point where incomes are keeping up, and it'll be easier to keep up with these higher prices. Powell had said Wednesday that even if Friday's inflation figures came in unusually low, it would only have a limited effect on the Fed's outlook. Our position shouldn't change based on 2 or 3 points of good or bad data, he said at a news conference. We have a long string of inflation coming down gradually over time. We still have some work to do. So he's saying we're reeling in the cuts that we're going to do next year, and rates will stay a little bit higher. So that is our 2024 recap and into the 2025 forecast. So this is from the Seattle Times. I'll dig a little bit deeper into a couple of these and then breeze through a couple of them quicker. 5 predictions for the Seattle area real estate market in 2025. So, a lot of people in the Seattle real estate market, as with a lot of places in the nation, did stay put in their homes because moving anywhere else, it would mean taking on a higher interest rate, paying a higher price for that home. They crunched the numbers and it didn't make sense to move. People are tending to not move right now unless they have a compelling reason to. Elevated mortgage rates and high home prices kept would-be shoppers on the sidelines. Those same factors discouraged homeowners from trying to sell. In a few ways, experts anticipate a jolt to the market in the new year with an expected dip in interest rates, but the region's affordability challenges likely remain stubbornly stagnant. Here are 5 predictions for the Seattle real estate market in 2025. Number 1, home prices will continue to climb. It is unlikely that it will become much easier to afford a home in the Seattle area in the near future. King County home prices have more than doubled since the 2008 Great Recession. Since COVID, that spiked prices by 20% or more in a single year, depending on what areas you're looking at. It was crazy appreciation during that time and totally unsustainable. So Seattle area home prices could climb 4 to 5% next year, which is in line with this year's growth, which is a much more expected home price appreciation value. 20% is not a sustainable thing. 4% is a lot closer to where the average is for a longer period of time. For home prices looking forward, this is on a national scale. So these are 16 different entities giving their predictions. The average of all 16 is 3% price appreciation for the coming year, but they range all the way from Moody's Analytics slight depreciation of 0.4 to this AEI Housing Center of 5.5%. So the average of all these is about 3. So we'll go with that as a guess. Number 2 prediction is mortgage rates hover around 6 to 6.5%. This year, mortgage rates averaged a high of 7.2 in May and settled at 6.6 by mid-December, but nothing close to those early pandemic rates. So the National Association of Realtors chief economist Lawrence Yun projects a new normal around 6%. Danielle Hale, chief economist at Realtor, expects an average of 6.3% throughout 2025, 6.4% from Wells Fargo, and Tucker from Windermere at 6.5%. You can see they're all kind of right around that 6 to 6.5% range as far as what the outlook is looking forward. Prices and mortgage rates are not budging much. Economists do expect more home sellers to make more deals. So the lock-in effect is kind of waning. So that's what I was talking about when those sellers are stuck into their home. They don't want to pay higher rates to move to a smaller house. And that lock-in effect has held up some inventory, but people are only going to wait so long. People who really want or need to move can put it on pause for a year or 2 or 3, but they can't wait forever. Those people have to put it on pause, are going to start to feel the urgency to move. So we will see more inventory coming to the market in the coming year and more sales as those homes start to unlock and people are like, okay, it's worth it. It's time to move now. But any uptick may be modest as there's a difference between an improvement and a recovery. So it's not going to be everybody moves this year because that's not going to make sense for people either. It has to be based on their situation and how urgently they want to move. So that'll increase over the next few years probably. For mortgage rates projections, we have Fannie Mae, MBA, and Wells Fargo. The average of all three is showing that we will end the year at 6.33%. So really not too much change on mortgage rates throughout the year. And this is just that on a line chart. We're basically heading fairly flat, down ever so slightly from where we are at the beginning of the year. These are the pieces I'm going to kind of breeze through because I don't deal with many rentals, but rents are to remain high, but slow to rise. They said that the rents have not increased dramatically throughout the Seattle area. The reason for the price stability and influx in newly built apartments in Seattle that's expected to continue into the new year. About 13,000 apartments are under construction in Seattle, many on track to hit the market in the coming year. The flood of supply won't go on forever. As interest rates climbed in recent years, fewer developers sought permits for apartment towers. Compared with 2023, multifamily permit applications are down about 10% through October in the Seattle area, a significant decline, although still a better picture than 16% slide nationwide. So there's a lot of stuff that's going to be constructed within the next year and then drop off a little bit. So after that happens, rents may rise a bit. They rose on the east side more than in Seattle. And for single family home rents, they did tick up a little bit. In the Seattle area, it climbed 3%. And a median 3-bedroom single family home rented for about $3,600 a month. There was some legislature that was put up in Olympia that did not go through, trying to get some rent hike limits, but there will probably be more of those types of bills heading forward. Office market woes will continue. There's no pre-COVID normalcy in sight for Seattle's commercial real estate market, especially the city's many partially empty office towers. So lots of empty office space in Seattle. People have not come back to working full-time in offices, a lot more work from home than there used to be. And that looks as though it will continue, but it is up 23% from 2023. And the debate continues over building new housing. So there's been a lot of different conversations about ways to create more housing in the Seattle area. I know there's been a lot of ADUs, or auxiliary dwelling units, or those backyard cottages built. There's been some changes in the zoning starting to allow for people to have those backyard cottages or build a duplex instead of a single family home, and just trying to create more housing for people in this city and throughout King County. Incoming President Donald Trump promises deregulation and tax cuts welcomed by developers, but he also has vowed to undertake an immigration crackdown that could worsen the construction industry's labor shortage. Trump has also floated tariffs that, if imposed on products like lumber and steel, could drive up the cost of building all sorts of housing. So there's a couple things that are projected to do good things for home prices and some bad things for home prices. So we'll see where that balances out, I guess, as we move forward and the new administration takes over, and see what happens there. For total home sales forecast to rise, this is the number of home sales in millions. The current pace is 4.6, and we're pretty much at a low point here, projected to go up to 5.1 million sales in the US next year. 2019, 2020, 21, we were going up, and then the rates started to rise and home sales started to drop. And looking forward, it's likely that we'll consider 2024 a low point of home sales in our history. And this is headed up towards another peak at some point. But we are projected to have more home sales next year than we had this year. And this is probably the low point. Looking ahead into 2025, my baseline expectations is that single-family home construction is poised to steadily increase, bolstered by modest declines in financing costs for builders and buyers, and by the scarcity of existing homes due to the mortgage rate lock-in effect. That's from the Deputy Chief Economist at First American. And that is the 2025 forecast. Just a couple notes here. Fall buyer and seller guides are available, as well as a first-time home buyer guide. I can email these to you, send you a PDF somehow, or send you a hard copy in the mail. Whatever's easiest, I can get one of these to you. And I have a few upcoming classes here. January 9th is my next one. This is geared towards first-time buyers or people who haven't purchased in a while. House Hunting Made Simple, a beginner's guide to home buying. The next one is a perfect transition, selling your home and buying your next. And that's on January 30th at 6 p.m. So if you need to use the equity in your current home to purchase your next one, and you only want to move once, but you need that equity to buy the next one, this class is for you. We'll break down several different solutions and find the right one for you. The third class coming up is February 7th at 6 p.m. These are all webinars, by the way, is Investor's Toolkit, a beginner's guide to real estate investing success. And I am excited to do this one. I am teaching this with a mortgage broker and a property manager. So there will be 3 of us up there on the screen giving our little insight on investing and how to start your investing portfolio. Several different ways to do it. Even if you think you don't have the money right now, there'll be ways to get funding, or if you need a place to live, how to start that as your investing portfolio. We'll give all sorts of insights on that. So I highly recommend that you come. If you have any questions, please feel free to reach out. My phone number and email address are in the description below. I am happy to answer any questions you may have about any areas you are interested in, or if you're interested in the value of your own home, I'm happy to have that conversation with you. And a very happy 2025. I cannot believe the new year is here already. This year has gone by so fast. And I want to thank everybody for joining me for this show over the course of the year. I wouldn't be doing this if it wasn't for you. So thank you so much for all of your support. Thank you so much for joining me throughout the year. I hope that you have found this information valuable and will continue to provide it in the year coming forward. It's been quite the year. So happy 2025. And I hope you have a fantastic New Year's celebration, and I'll see you next year.